And Wednesday wrapped up the second day of the Federal Reserve's two-day meeting here in Washington, D.C. All eyes were on D.C. to see what the Fed will do when it comes to interest rates. In the event, 9 of 10 members of the Federal Open Market Committee voted to keep the federal funds rate in the range of 2.25 to 2.5%, despite calls from President Trump to lower borrowing costs. Joining us now to break this all down is Peter Schiff, CEO of Euro Pacific Capital. Peter, it's expected that we'll see a rate cut at some point this year, something Fed officials have now pointed to as uncertainty increases, and they attempt to do whatever possible to protect growth the U.S. has witnessed. What do you make of the results of this latest meeting?
Well, you know, the Fed likes to work incrementally, so I think before they cut rates, they want to officially adopt a bias to cut, and that's exactly what they did today. That's why the probability that the Fed cuts interest rates at its next meeting in July is now 100%, and I'm pretty sure that is exactly what they're going to do.
That good hot take there, 100% likelihood of a rate cut at the next meeting. We know President Trump was critical of the latest rate hike in December, which was the fourth increase of 2018. And of course, he's been putting Fed Chair Jerome Powell on notice, noticeably on Twitter. On Tuesday, he asked whether he would keep Jerome Powell in the job. President Trump said, well, let's see what he does. Well, now we know there will be no change in the rates, so effectively this decision to leave rates where they are was a decision to reject Mr. Trump's advice. What is the future prospect now for Mr. Powell remaining at the Fed?
Well, he's going to stay at the Fed, but he's also going to cut rates. But, you know, it's not the right thing to do for the country. I mean, the reason Donald Trump wants lower rates is because he wants more air in the bubble. He's more concerned about his reelection than making America great again. When he was a candidate, he criticized Janet Yellen for doing exactly what he now wants Powell to do, and that is just try to make him look good by blowing more air into a bubble. But, you know, we are headed into a recession, and that's exactly what the U.S. economy needs, unfortunately. We need to deflate this bubble, and a recession is part of the cure. But Obama didn't want any part of that cure, and neither does Donald Trump. And, of course, neither does the Fed. I mean, Powell said that their goal is to keep the expansion going, even though the expansion is very dangerous because it is a bubble. But we're headed into recession, so I do expect the Fed to cut rates. But I don't think it's going to have the reaction that everybody hopes. I don't think it's going to be good for stocks or good for long-term bonds. I think it's going to ignite inflation in consumer goods, not in financial assets. The price of gold is a good harbinger. It closed at the highest price of the year today. Gold prices are going a lot higher. The dollar is going a lot lower, and we're going to have stagflation in the United States.
Right. And speaking of gold prices slipped a little bit this week after having set a 14-month high ahead of the statement on what will happen with interest rates. Now that rates are holding steady, we're already seeing gold prices move back up. What are we looking at in the near future when it comes to gold?
Well, gold is up against the 6-year resistance, but all that resistance was against the backdrop of the Fed tightening. The Fed was going to do quantitative tightening. They were going to be raising interest rates. That backdrop has now changed. We are now in an official easing mode, and that is going to be very bullish for gold. So I do believe that with that backdrop, gold will be able to break through this resistance, and then it's going much, much higher very quickly.
Interesting. And 10-year Treasury bond yields sank to their lowest level since September 2017 due to the uncertainty around the meetings as well. And they, of course, bounced back after the Xi-Trump meeting at G20 was confirmed. What do we need to know about that situation?
Well, I think what's going to happen when the Fed finally cuts rates, it's actually going to be bearish for the the long end of the curve because of the impact the cuts are going to have on inflation and the dollar. And, you know, if you have a 30-year U.S. Treasury, if there's a lot of inflation, that destroys the value of that bond. And, of course, you know, the bond is denominated in dollars. And so if the dollar is losing value, then the dollar is going to lose a lot of value over the term of that bond. So people are not going to want to hold these treasuries. And so if people who think that lower interest rates are good for long-term bonds don't understand the long-term bond market. The short rates will come down, but I think the long rates will go up. So the curve is going to steepen, and that is going to be very problematic for the U.S. economy.
And just quickly, you say we're in a bubble. The U.S. economy is in the bubble. Where is that bubble? Is it a housing bubble? Is it a stock bubble? Or is it distributed throughout the economy? Tell us about the bubble.
Well, it's pretty much a bubble in all financial assets, and you can see the effects of the bubble in our budget deficits and in our trade deficits, which are running at record highs. You know, we're running the biggest budget deficits we've ever had, even though the economy isn't even in recession yet. We're running bigger deficits than we ran during the Great Recession. We have a consumer bubble. Americans are consuming too much and borrowing too much. Businesses are borrowing too much and spending too much. They're not investing. They're not saving. We're living off of imports and consumption credit. And this thing is a gigantic bubble. And the Fed, of course, is trying to prevent it from deflating, but that is the best thing that could happen long term. But of course, if we're going to deflate this bubble, that means a lot of debt is going to get defaulted on. There's going to be a lot of bankruptcies. That means the federal government's going to have to cut a lot of spending. A lot of difficult choices are going to have to be made, but no one wants to make those choices. They want to postpone the day of reckoning to some future date. But the longer they do that, the bigger the problem gets, and the more reckoning we end up having to do. But of course, politicians think, well, let's just get through the next election because maybe I won't be in office, and so that's somebody else's problem. But that kicking the can down the road, we've been doing that for years, and that's why we're in so deep a hole right now, and that's why this next crisis is going to be so much worse than what we had in '08.
Very interesting analysis from Peter Schiff, CEO of Euro Pacific Capital. Thanks so much for your time.